So hello and welcome to the Data Explorers Market Update with me, Will Duff-Gordon, not wearing any fancy dress today. And that's suitable because I'm talking about the rather dry subject of pensions and deficits. The point I want to make is that there hasn't been very much focus on pension deficits and liabilities, considering all we've been talking about this year is sovereign defaults and BP's oil spill, government deficit reduction, all these things. And what's not gone away, though, is this issue that we're all living longer and company pension schemes are continually struggling to meet their liabilities. The kind of hook is that BT recently had a major, they had two wins from the government. One, the government's going to support the pension scheme for our biggest mobile phone or our biggest phone carrier. And secondly, they decided to say that the valuation of pension schemes should not be done off should be done not off retail price inflation, but consumer price inflation. And consumer price inflation is much less inflationary than the RPI, which was worth to BT something like 2.9 billion was how much it reduced their pension deficit by, and therefore that was worth about 27 pence increase in their share price. Blah blah blah. But what I'm basically saying is, what is going on here, and are investors tuned into these big companies that have big sort of pension liabilities hanging over them because they've not really been in the news. Now, the reason why this is interesting is that there's an investment theme this year that big is beautiful, that companies with huge franchises that have been around a long time are the ones to weather the current storm. But they're also the ones with the biggest pension deficits, so it's kind of it swings and roundabouts. So in BT, short interest is very low, and institutional investors own lots of BT, as you'd imagine. Although if we look in the ADR, it looks like some US investors have recently borrowed about 60,000 of the BT's ADRs, so there's been a little bit of short selling from US investors. BT's at a 52-week high, maybe they think it's gone too far too fast. There's a company called Pensions First, and they've come out, they're trying to move thinking and say, rather than talking about the size of the deficit, which is currently 43 billion across the FTSE 100 companies, let's talk about the likelihood that that deficit is going to change, using kind of the best methodology that they've come up with. And apparently there's a 1 in 20 chance that in November of this year, that 43 billion could have moved by 25 billion or more. There's 1 in 20 chance of that happening according to their value at risk calculation, which is sort of huge. And if we just isolate one component of the risks, which is inflation risk, if that was to move by 1% long-term inflation, that could add 60 billion onto the pension deficit, so the pension liability. So it's pretty interesting stuff, and though a dry subject of interest to us all. Amec is a big UK infrastructure project provider. They are doing lots with the Olympics here. They have quite low short interest, but it did recently rise to 2.3%. Their shares are at another 52-week high. And the reason I mention them is because it's quite interesting. They are going to offer graduates a 9% student loan repayment instead of a defined pension contribution, thinking that students leave with more and more debt. One way to entice them to join them is to essentially be one of the first graduates to be able to pay off their student loans, worrying about their cash flow now as opposed to later. Institutional investors own loads of Amec, and they're very bullish about it. Look at Royce, BP, Marks & Spencer, all of these companies, short interest is pretty low, and these are the companies with big pension funds. So I'm attempting a subject probably rather more complicated than my abilities, but it's on paper. If you want to read it today at dataexplorers.com/news.